quite a substantial move in the yen, perhaps driven then by some of these BOJ comments, keeping us alive to the idea that we might get another hike from the BOJ on the same day that we're waiting for US data to come out, this time CPI. What do you read into this yen move this morning?
Yeah, this is probably the big move. While we were all focused on the debate this morning, that didn't probably drive markets as much as this comment. And that's because this is a generally perceived as dovish member of the BOJ making a hawkish comment and basically implying that there's consensus they want to deliver more hikes. Now, I think that this means that, we obviously did see dollar yen come lower. It's hard to fight yen in the short term. We're close to some pretty big technical levels. So dollar yen downside continues to gather momentum. And it's hard to see that change in the kind of short term. At some point, though, I don't see this yen move as sustainable. BOJ are depending on the idea that they've got self-sustaining inflation because of a strong consumer, when there really isn't just the economic evidence to back that up. But that's probably a trade to fight maybe a few months from now, definitely not in the short term.
Mark, how bad does CPI need to be today out of the United States to push the Fed towards 50?
I think the dynamic here in the Fed is that Powell wants to do 50. He's got a dovish reaction function, but it does seem like the Fed is going to 25. They're in the blackout period. The Fed won't want to shock the market. So basically what you're kind of asking is how much does it need to miss for the market to price in 50 basis points? Because unless the market is pricing greater than 50% chance of 50 basis points, the Fed will not do that. It would send a negative signal. They're suddenly panicking. So I think it needs to be quite a significant miss. And in reality, I think the volatility in the forecast for CPI have gone away. If anything, there might be a slight upside hinted today. So I think it's very, very unlikely that we get the data print that gives us 50 basis points next week.
Mark, off the back of that, I'm looking at a 2-year at 356, a 10-year at 361. What's the ceiling? What's the floor?
I think that 2-year, it's hard to go much lower. I think we've priced in an extraordinary amount of cuts. And I think until we get confirmation that either financial markets, there's some kind of hidden crisis in financial markets, which doesn't look likely, or the more likely scenario that a recession in the US is either begun or is imminent. Now, I am personally in the camp that it doesn't look that imminent, but of course recessions never look imminent just before they happen, and therefore I'm staying open-minded, but I am not in the camp that a recession is imminent, and therefore I think that ultimately we'll see two-year yields rise over the coming couple of months. But I think, again, in the short term, you can't fight that before the Fed next week. I also think the curve will continue to steepen, as your guest outlined just before the break there. I do think that the fiscal situation by either presidential candidate supports that steepening of the curve. So I think 10-year yields also have upside from here, but who knows in the short term.